regimes, either regimes that are so fundamentally chaotic, they're breaking all the risk metrics, like March 2020, regimes like, I don't know, oil trading negative, or even like as we entered post 2020, sort of the call option spree of retail buyers, which I know you had a lot to say about, but correct me if I'm wrong, there's actually no trade you guys ended up implementing as it relates to that. At least the last time I spoke to you on that subject, maybe it's changed. So how do you sort of think about navigating when quant models maybe like just either aren't giving you right answers, or the world is chaotic and the systems you've built aren't designed for that world, or the world is fundamentally changing and there are new opportunities arriving, and figuring out what sort of models you need to build for that?
I think the world's always changing, and that's kind of part of the whole point, right? The conversation is about, are there variables that we're missing in how a strategy's model is set up, right? So, for example, think of variance convexity basis got very expensive after COVID, and there are strategies that we have that effectively trade a linear format of that variance convexity basis. And based on historical data up to that point, the way that our models were looking at things, you would have wanted to bet very aggressively on convergence of those spreads, but you also knew, because you hadn't had a convexity blowout like that, really, 2008 in a way, but actually it wasn't the same. March 2020 was actually a much more severe convexity blowout than 2008. 2008 was a big crisis that kind of steamrolled on and got twice as bad every month. March 2020 was like this month volatility is 10 times higher than last month, right? And those are two very different things. As a result, the world lost all of the sellers of tail convexity, and they're not coming back soon, right? And so there's just no reason to think that your model would be right anymore for how to measure, the expected returns of some kind of where should VIX futures trade relative to S&P at the money forward.
What the fair convergence back would be.
Exactly. So you think, okay, maybe in 5 years you think you have where it's going to go to, or even 2 years, but not in 2 weeks, right? Whereas if and so you have to stop and think about that, and you have to think about, okay, we need to probably look back and put more weight on actually the term structure variance basis and where spot variance basis is, because that really matters a lot, and go through and really think about things that maybe didn't matter as much before, or you didn't realize how much they matter but that have since become much more salient, right? So it drives sort of re-engineering. It would be very rare that it's just nothing makes sense. We'll have times like after March 2020, we absolutely there were some trades that looked good that we just didn't do during March of 2020, right? Because a period that crazy, you're working a lot, you're doing a lot of things, your attention is getting pulled in a lot of different directions, you're trading all day, and that there's a value to having, focus all efforts on the highest risk reward and highest ratio of reward to complexity opportunities, right? Don't go out and do things where now I need to trade a ton of different option line items and put on this very nuanced trade that I have to leg into, because in this environment, that's going to be extra hard. And then every day I'm going to have to pay attention to it and maybe miss this other thing, right? And so, and are you going back and rewriting your whole portfolio construction models to do that? No, you're just not doing that trade. That's very easy, not easy to do.